I had my other projector, and my family took it home during the holidays because they wanted to watch a movie with it. And for those of you who know me, I've got 8 kids, and I have no idea where that projector is at now. So I don't know where it went, what happened. So anyway, we are going to get started. Feel free to eat and grab any food you want back there during the presentation and everything else. Some quick introductions about me. There are some people here that I don't know and that don't know me or don't know anything about what we do here with our company. Okay. First of all, I've been in real estate now for it's almost 20 years. When I started, I bought my first place. My wife and I were first married. I was making $9 an hour at Key Bank, and I bought a triplex, converted that to a fourplex. Made my first $50,000 in real estate when I sold that, and then I bought, after that one purchase, the next 2 years, we bought about $2 million worth of property, me and a partner of mine together, with $30,000. And so I've done a lot of different things. From that point, I've bought and sold hundreds of properties. I've flipped hundreds of homes, and that's no exaggeration. And I've done hundreds of multifamily kind of value add projects. So we're going to talk about that strategy today. Over the last 20 years. I am no stranger to failure. I have lost everything in the financial crisis. I'm really open and honest about that. You learn way more from your failures than you do your wins. And in order to stay out of bankruptcy and everything else, I had to sell everything I had and was left with $100,000 left of debt and still had to pay that off. So. And then I rebuilt from there, and now we're approaching a little over $7 million in aggregate real estate value now from that time. And I've done, from that time, hundreds of deals since then. So anyway, I know the good, the bad, and the ugly of it, and we're going to go over into that. And we're going to talk a lot about, today is all about inflation, and inflation is really all about timing. So we're going to talk a lot about timing, okay? I got a story to tell you. So my undergrad's in economics, and my master's degree is in Masters of Real Estate Development, both from the U. So I'm in one of my undergrad classes is in macroeconomics, and my professor, Professor Jameson, really liked him a lot. He was a great professor, taught me a lot about economics. He started talking about, and we had a whole class on the trade deficit back then, and how bad it was, and what it was going to do to us, and you know, the woes of it, and he talked about Social Security and how screwed up it was, and that we're all screwed and we're never going to get it. And then he said, no, just kidding, I'll show you how everyone's going to get it. And then so putting this like fear of God into us, I raised my hand and I said, hey, Professor, this is all great to know, but how does the lay person protect themselves against the woes of government? And he said, Aaron, most economists are poor. And he said, if economists knew the answer to that, we'd all be rich, right? So I remember sitting in that class and determining at that time, you know what? Grab her a chair over here. You could move that wherever you want. So anyway, I remember at that time deciding I have to figure out how to take this information and dumb it down to useful bits and pieces. Right? So understanding all the different things about inflation, that's all fine and dandy. Believe me, we can go super deep and nobody wants to, okay? But it really comes down to 2 things. Inflation, there's demand pull inflation and there's cost pull inflation. We're going to talk about both of those real quick, then I've got a really cool exercise that I'm going to need 3 volunteers to kind of teach this concept. But this is how we need to think of inflation with these 2 concepts only, all right? So demand pull inflation is more demand than supply. We talk about that all the time, right? So if 5 of you right now want a bottled water and I have 1, what's the price of that bottled water? The highest bidder, right? Now let's change the scenario. If we're walking in the middle of the Sahara Desert and 5 of you want water and I have bottled water, 1 bottled water, what's the price of that bottled water? Exactly, right? So circumstances change it even within that. So that's the other thing with forecasting. When we start thinking about the markets in general, we have to think of it in context, into circumstance of what's happening with people and everything else. It's not just as simple as a supply and demand equation. So there's a human aspect to it. That's why I bring that up. All right, so that's basically demand pull inflation. It's known as too much money chasing too few goods. What do we have right now in the real estate market? Too much money and too few goods. So what's happening to the price of real estate? Going up, right? So I employ a strategy with my home equity line of credit on my house. And I've used it a lot to make good returns on flipping homes. And I have very specific things I do with it. For anybody who's sat down with me and talked to me one-on-one, and I help you make a real estate plan, you know that. And I talk to you about doing that for yourself as well. Now, with that home equity line of credit, I have refinanced that every 6 months for like the last 3 years because my home value keeps going up. And I call the appraiser. So I use a really small credit union for this particular strategy. There's only 4 employees. I love them. They're great. And the appraiser is a good friend of mine. I've known him for, 16, 17 years. Anyway, I call him and say, hey, Bob. He's like, hey, Aaron, how you doing? I'm like, yeah, I need you to come and appraise my house again. Is it 6 months already? I'm like, yeah, it is. So because it's been going up. When it goes up 5%, well, 5% on 500,000, it's 25 grand or whatever it is. And we've been having really good appreciation over the last several years. So, and it really all comes down to this demand pull inflation. That's what it is. It is just there's more demand than there is housing. What created the demand? Let's talk about that real quick. What created it?
Well, 2 factors. One, there's more people buying houses. That's because of a small number of people in a house, and also we had a baby boom from the late 80s to the 90s.
Yeah.
So that's part of it.
Okay. What else? So a lot of people. Strong economy. Okay. What else? In-migration. Okay, into the state of Utah. How many people through in-migration and through natural birth do we get in the state of Utah? Keep in mind the Wasatch Front covers about almost 90% of these people. 60. Really close. Good guess, right? 60,000 people coming in every single year into Utah right now. That's a big deal. So how many households would that be? Assume that there's probably 30,000 men, 30,000 women, that kind of thing. But then also single people create their own households as well. So it's more than 30,000 households. So it's probably somewhere around 40,000 households get created on a yearly basis in Utah. How many housing units did we do? I don't have the stat for 2017 yet, but 2016. Anybody know?
21,000.
Yeah. Is that a supply and demand problem? The shortage of almost 20,000 households or more than that. Okay, so here's the thing with housing. Okay, think of this like the box. So I use this to kind of understand economic principles. Everybody has to fit in this box. Your only way out of the box is to die. That's the only way out. Okay? Everybody's in this box. So people are coming in through birth, whatever. Everyone's got to go one of a few places. They either own, they rent, okay? They bunk up, or they're homeless. Right? Okay? And so during the crisis, the financial crisis, what happened? This is what happened. The 7-Eleven clerk bought 3 houses, and they were all worth $500,000 with a no income, no asset, he had a job, ninja loan, right? And he had 3, and he's like, hey, great, I'm going to be a millionaire. Couldn't support that, okay? There were lots of real estate investors that did all kinds of crazy stuff. They took advantage of, you guys remember negative amortization loans? Yeah. Oh yeah, real estate. I remember going to seminars and they'd say, real estate never goes down in value. It only goes up. That's not true, right? Like, what goes up must come down. We're always going to have corrections in the market, and that's okay. They're healthy for us. But so what happened? We had all this extra inventory, okay? And then we had the financial crisis. Unemployment goes up to 10%. What do people do? File bankruptcy, lose everything, don't have a job. Who do they move in with? Mom and dad who have their home paid off or have a super low mortgage. I had one family that had 7 adults living in the home through, married couples and everything else with the parents. And with 7 adults, they could not make a $2,100 house payment. They were losing the house. And so they're all bunking up and, they're just surviving at that point. You're on a different kind of mindset, right? And so I can totally understand what that happens. But so what happened, so more people went into the bunk up stage. Let's go live with mom and dad, with grandma and grandpa, wherever. We'll live 2 families in one house to make it affordable, 2 families in an apartment. It didn't matter what it was. Unfortunately, there were some that went homeless, right? That kind of thing. And then ownership. So ownership and rent splits up the rest. Okay? So this is called, all this stuff down here, I would say this would be regular demand because we can, or trackable would be probably a better word, trackable demand. People who are renting, we can track that demand, right? But did you guys hear about, they called it the phantom demand or that pent-up demand? That's all here. That's where all of that was. We were not building. We waited for inventory to get absorbed up. It got all absorbed up. After 3-4 years, people have jobs again. Their bankruptcies have seasoned, or now they saved some money, they paid off some debt, etc. Whatever happened during that time, they start to get ready to buy homes again, right? So you have a lot of people starting to flood the market. And so they move from a different sector and they want to move over here. But yet, nobody's building, we don't have inventory. So what does that do? It creates that demand and supply problem, right? Okay. So, now you guys will know that from the time you're born, you're always in the housing box till you die. Okay. So cost push inflation. Cost push inflation it basically is a result of lower supply and higher prices. So it's where inputs cost more. For instance, gasoline. When gasoline prices or crude oil goes up a lot, oil and gasoline make a lot of stuff. Okay? A lot of stuff. And transports a lot of stuff. Prices of goods go up. So if you're a supplier, think of it this way. Why would supply go down just because the cost of goods go up? Tell me why that's the case. If you're Apple, you can go, well, Apple's probably not a good example because they're ginormous, but if you're somebody besides Apple who has finite funds, okay, and the cost of goods, you say, hey, my quarterly budget to produce 1,000 widgets is $10 million, right? Well, now to produce those 1,000 widgets, it's going to cost me $12 million. I still have the same employees, the same overhead, the same everything, and I can only produce 950 widgets with my $10 million. In order to make the same amount of profit, what has to happen to the price? Raise it, right? And is it justifiable? Why? There's a really important reason you understand this. No? That's a good thought, though. Demand didn't change, right? Nothing happened to the demand for it. Even if you're throwing out tomato soup, whatever it is, the demand for that tomato soup didn't change overnight, right? Now, it will change because the price goes up, so people will choose not to buy it, which will curve that down. But that's what it is. So the important lesson to remember here is this. What is the, I'm just going to make a mess back there. So What is the main driver for inflation? Demand. Somebody define demand for me. Who is demand? Consumers, exactly, right? Us. Okay, so that's really important because if you want to create good strategies, especially when you're talking about real estate, you need to understand the people. You need to understand who drives that market. That's what it's all about, okay? In the financial crisis, if money was freed up so that people could buy the inventory out there, we would not have had the phantom demand that came up out of the woodwork later on, if we would have created some path for them to do that. They tried to do different things with the home loan modifications and different things like that, but it wasn't successful, right? What they needed was new capital because there were a couple things that went wrong. So it wasn't just that people couldn't get loans, is that banks and lenders didn't have money to lend, right? That was also part of it. So that's a whole other section to talk about that whole crisis. But anyhow, it's really important to remember about the demand. So whenever I go out, and you can talk to anybody, Cody, Kelly, how many times when we look at a property, I'll say as we're analyzing, I'll say, what are the clientele? Who's going to live here? That's the first question I ask myself on every single one. It is not, well, what do I think I could sell it for? No, who's going to live there? Because that's going to determine how I'm going to remodel it, what I'm going to do, how much I can charge for rent, the type of the clientele, their credit score, everything. Okay? I don't discriminate for any reason. I could care less what race they are. I could care less what sex they are. I could care less about any of that. I do care what group they place themselves into, because that group that has certain buying power and behavioral patterns that help me determine what I need to do for that particular property, right? So let me give you an example. Avenues. Demographics in the avenues have changed significantly since I was a kid. I grew up in Rose Park on the west side, and I went to West High. All of my buddies were in the avenues, most of them. And so I spent a lot of time up there. And it was a great experience because I got to see two different worlds and kind of the differences between them. Funny story, in fact. So one day we were driving home. This girl, a friend of mine, was driving us home, me and my brother, and she comes to and she had some other friends in the car too, but she comes to a screeching halt at the train tracks. And we look at her, what are you doing? She's like, my mom told me I could never go past the train tracks. And I said, well, I live like 2 miles down that way, so you're going to have to, or I'm going to hoof it at 1 a.m. or however late it was. So anyway, it was just kind of interesting to see the two different cultures and everything else. But so in the avenues back then, when I was growing up, a lot of families, tons of kids. There's kids all over the place, right? It's completely transformed. It's still a wonderful area, great place to live, but there's not nearly as many kids in the avenues anymore. There's a lot of, I guess you would call them hipsters, millennials, living in the avenues that want a certain style, right? And so now, when I just did a flip in the avenues, and I made a mistake on that one, right? So the other thing that you'll see me do on every single project, I evaluate every single one. And I say, now I made money on it. I made money on the flip and everything else, but I could have made more. But I made a mistake because I didn't think hard enough about the buying clientele. And I think about that all the time. We remodeled it right. We got the right design. We got a designer in there, everything else. Did all that correctly. It was a floor plan issue that I screwed up on, right? And so you learn from that. But back in the day, I remodeled that house. It only had 3 bedrooms. And one of the bedrooms was in an apartment upstairs. And I sold it for, what was it, $540? Something like that. Okay? And you would think, well, God, this is Utah. Like, everybody has 8 kids. No. We're going to go over my little example here for inflation. What are some of the demand preferences that are changing in housing right now? Open concept, right? Like when I was a kid, you had your family, your living room, then you had like a family room downstairs, your kitchen. You didn't want anybody to be able to see your kitchen when you walked into the house because it's always messy. Now it's all open and, you know, everyone walks around in their underwear and that's okay, right? So, but that's what it is. Open concept, big deal, right? What else? Neutral colors. Yeah. They want an office. Smaller yards, right? Okay. Ensuite, yeah. Structured wiring. That's because of your company. Yes. So more technology, right?
More high-end finishes.
High-end finishes. So here's the thing. I remodeled an 18-unit downtown, and I do a lot of value-add projects for multifamily. And this particular place, the one bedrooms, it's right on 1st South and 9th East. Great area. Okay, the one bedrooms are about 450, 500 square feet.
500 to 650.
Okay, so the big ones are 650 square feet. We rent them out on average for $1,000, $1,100 a month. Okay, what we did when we went and remodeled them, we blew out a wall, so it's all open. We put a little island in there, good finishes, that kind of stuff. And it has radiant heat still, has updated electrical, has updated plumbing, and it's a window air conditioner. And we still get that all day long, and we're raising rents. So anyway, but those finishes are really important. How we finished it was really important. Okay, so, but it's important that we understand the market that we're going into, right? So let's do this little thing on inflation. All right, I need 3 volunteers. All right. Yeah, you should have volunteered, huh? Okay, so let's talk about how demand pull inflation works. Okay, guys, why don't you guys stand right here? I'm going to use this little thing here. This will help us understand a little bit more of how this all works. Okay. I don't know if they're going to stay. Well, I'm going to have to do it in my hands. Okay. Okay, guys. So what's important to know is everybody has the same money. All right? So here you go. Take $10. Take just 110. Okay. Take a 5. Oh. I should have did this in quarters. All right. Okay. So, all of these $20 bills represent property you can buy, okay? And now, they are all for sale. Everybody can buy one. Every single one of you, if you want it, okay? So, all of this represents that. You're going to buy one. Everybody here is going to buy one, okay? How much are you going to pay me for one of these? I want $10, but what are you going to give me?
I'll start my bid at 10 and see if someone outbids me.
Okay.
Well, you can get one.
All right, I'll take your 10.
I'll go 15.
Here you go. You're going to give me 15? Okay.
You can go 8.
Take your 5. Look, that was an example of why you guys need me really bad. Okay? When there's 4 houses, 4 supply, and I have to sell one, right? Pay the least amount possible. Okay? There's more supply than demand. Prices would go down for the same value. So you need to understand that. Okay? All right, now let's do another example. Everybody got their money? In fact, let's do this. Okay, 2 properties, valued at $30 a piece. There's 3 of you. Now, how much will you give me for it?
I'll pay 5 for a 30.
I don't know if I want 5. Will anybody give me more than 5? You'll give me 10? How much you give me?
I'll give you 20.
20 bucks? Anybody give me more than 20?
I'll give you 20 for both of them.
Okay, I'll take the 20. Okay, now there's one property for both of you.
How much do you want?
30 bucks is what they're valued at. You decide how much you want to pay. You're willing to pay 10? How much are you willing to pay?
5.
5 bucks for it?
Take it or leave it.
At this point, in the real market, what would I do?
Oh, you walk away.
Yeah, I'd say no because another bargainer is going to come and give it to me, right? But because it's not the real market, I'm going to give it to you. So stay up there. But that was demand pull, right? So what did that mean? What was the illustration? When you take away the supply and you have the same demand, prices go up, right? If all of you guys knew you were going to be able to keep this money, how many would have volunteered? All right. Okay. So, all right. So the example doesn't work really well for cost push. So what I'm going to do is you guys, here, split that up. You all get 100 each. Just figure that out, Parker. I know you're honest. So you could do it back there, though, so I can keep talking. Anyway, give them a round of applause. Thanks for coming up. Here, go back there and do it. So demand pull inflation is a pretty easy concept to understand. Cost push is a little bit difficult, a little more difficult to understand. But it all comes down to demand, and it all comes down to funds and finite funds. So now that we know this, what is our inflation? Okay, yeah. So we're going to skip over that. Actually, no, we shouldn't skip over that. All right. So this is some of the predictions that I have. So Aaron Haaga's predictions, okay? Forget this oil on the rise. Nolan and I had a conversation about it. I told you he was smarter than me, and he told me I was wrong on that. So we're going to talk about that in just a minute. Rising inventory, though, this is what I think is going to be happening. Demand is going to continue to outweigh supply. I think it'll correct in the next 2 to 5 years, but I think it's going to continue to outweigh it, especially in Utah and some of the western states. Okay, Utah is expected to be the number 2 highest appreciating state in the nation this year. Okay, but there are other states that are expected to go flat and even some slightly correct downwards. Okay, so it's something to understand that is trending in a different way now, but we're still expected to have over 5% appreciation this year. Okay, all right. So job market, our unemployment rate is at 3.1%. What is full unemployment? What is considered full unemployment to economists? 5.5, actually. 5 to 5.5 is considered full employment. Okay? So,
I have a question about that because in Utah they don't pay nearly as much as they do in even Arizona.
yeah.
You know, and like an accountant here makes about 40, other states you can make about 60.
Uh-huh.
So I don't understand why that is.
Okay? There's lots of reasons why, right? Okay, so there's cost of living reasons, there's demand and supply reasons and everything else. And so those things will start to change.
It's higher here in Utah than it is in most of the country.
So now we just had our lesson on prices with inflation. Why would that be?
They can get away with it, I guess.
How much can a dentist make in D.C. versus a dentist in Salt Lake City or Holiday, Utah? Anybody driven through Holiday recently? How many dentists are in Holiday? 1 million, right? So how much? No, it's a real thing. Why is it that a dentist will make $250 or $180 out of school back east or some other state, and they'll make $80, $90 here, and sometimes have a hard time finding a job in Utah? Saturation, right? There's more supply than demand. Okay? Because everyone's like, hey, I got 4 brothers that are dentists. Why do I need to hire you? Right?
Also, cultural aspect comes into play. People want to live here, certain people. And so
Yeah, so the demand for that type of stuff the people want to stay, so they'll take lower wages because they want to be here. And that happens, right? So if you're in a place like North Dakota and it gets like negative 80 degrees below zero in the winter, you're like, why am I here? That might be a reason why North Dakota isn't as big as other places, right? So, okay, so that is the reason. There are more people that are willing to do that work here and educated to do that work than the demand allows, which is a price difference, okay? All right, yeah.
Your 40 grand buys you what 60 grand buys you in Phoenix here anyway.
Yeah, exactly. So cost of living, right? That's another factor that can come in. If the cost of living is cheaper here, then the prices will be lower. For instance, if you're doing the exact same job, say you're an accountant here for $40,000, you go be accountant in San Francisco, what are they going to have to pay you for a cost of living differential? A lot more, right? 120 might get you like a studio cockroach-infested place in San Francisco. I don't know what the cost is. My brother-in-law who's doing the recording right now, he's an accountant, and he was looking at a job offer in San Francisco, and it was crazy the prices of housing, right, when we were talking about it, when you were looking at all of that. So it is a significant cost of living difference, okay? All right. So what does this mean, though? What has to happen to attract more people? We're essentially below 100% full employment. So what is it? We have a supply and demand problem. We have more supply of jobs than the demand for them, right? So we have less people to fill those jobs. So what has to happen for employers to fill them? They have to pay more. They have to do something to entice people. So they do lots of different things. My brother works at Pluralsight, great company. It's going to be a rising star here soon, right? It already is, but it's going to go public, I'm sure. But anyway, at that, it's like a freaking playground there. I go there, he's like, hey, you want a drink? It's 7-Eleven in his place, and it's completely free, everything, right? And he still wants to go to lunch. I'm like, why? Like, it's free. Why would you go anywhere? Why would you pay any money? That's a big perk. Anytime they want, they got pool tables, they got loungers, they got blah, 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 blah. And the whole environment is, hey, we trust you. You're adults. Get your work done, that kind of thing. And it works. They've got a great environment, and they all work hard to make that environment work, right? So those are part of the incentives that they're starting to offer a lot of employees. A good work-life balance, good work environment is a big, big deal. Now, plus, though, so when my brother started there, he started at like $40-something thousand a year, and now they want to convert this to have real production. He's now a salesman making 6 figures plus within a year because they changed their whole model and they needed to bring other kind of talent in. They dramatically changed their pay structure, right?
There's a new company coming to town, I can't remember who it is. Their starting wage is gonna be $250,000.
Yeah, that's great, right? So why are you guys all sitting here? Why don't you apply for that guy? No, I was kidding. So anyway, but what I'm saying is wages are going to go up. So that's really important to understand. It just has to. There's only so much you can squeeze that before things start to pop. That brings in other things that we have to talk about too, okay? So inputs, so on the cost push inputs, rising wages, so it's going to cost companies more money to employ people, okay? Forget about oil. Oil prices are not, it looks like they're probably going to not rise, especially because Trump opened up a whole bunch of different drilling. We're doing a lot more drilling here in the U.S., etc. Anyway, like I said, no one's smarter than me, so we'll forget about that. But energy costs are increasing, right? Anybody get an increase in their power bill? Gas bill? Come on, man. I live in a small house, 2,400 square feet. My power bill is $450. It's because my kids never shut a light off. That's why I need you, Glenn. We need to talk. So anyway, but that's something to be thought about, right? So those are some of the things that are going up. What else has changed in our world? So internet, is that a need or is it a want? It has become a utility, right? And I would argue validly so. I really would. Okay? And other people say, well, you could go to the library. Yeah, well, the library closes at whatever, and then I got to sign the thing, and I got to wait. It doesn't make sense, right? Okay? It has become a utility. So we've had added things because of our technological advances that have added to our bundle of goods as consumers, right? All right. Inflation needs money to grow. Don't let anybody tell you that's not true, because it does. It absolutely needs money to grow. So, which is why the feds, what they do to attack inflation, they restrict the money flow. By raising the rates, they're taking money out. They will also sell their bonds and burn the cash, basically, to restrict money flow. Okay? So that's a whole other situation. But tax reform, whether you liked it or not, whether you like the administration or not, I don't care. Okay? It doesn't matter whether you're a Democrat, whether you're a Republican, whether you're libertarian, or whether you're something else, Green Party, none of that matters. What matters is how you play the game with the rules that are given. That's all that matters, right? So, tax reform, when they came about, I said, you know, it's going to bring $1 trillion back into the economy. It's looking like it's $2 trillion now, and it may even go higher because of repatriation of the money, right? That's a big deal. So Nolan's wife works for JetBlue. She just got a $1,000 bonus saying, thank you, we just brought a bunch of money back into the U.S. and we thought we'd give you a little bit of it. Where's JetBlue going to put that money? They paid their employees some money, makes their employees super happy. $1,000 doesn't sound like a lot of money. But geez, if you got a couple kids and one of the braces, it just paid off a debt, right? Did lots of different things, put tires on the car or whatever, right? Bought that new iPhone that you've been waiting for. Okay, where's JetBlue going to put the rest of it? They're going to pay shareholders, right? What are shareholders going to do with it? They're going to buy more JetBlue stock. And what is JetBlue going to do with that influx of money? They're going to buy more planes. They're going to get more hubs. They're going to expand their business, and they're going to need what? Employees. So any way you slice this pie, all that money coming back into the U.S. creates a ton of opportunity, creates more jobs, creates more of everything, okay? With an unemployment rate in the nation of 4.1%. So what's going to happen to wages? Does anybody dispute that? Does anybody, and I'd be open to the argument, does anybody disagree that wages are going to go up? Okay, great, awesome. So we'll say that's a given, okay? All right, so what affects real estate? So if we're going for higher inflation, the Fed's going to start taking care of stuff and, you know, restricting the money supply, okay? But why is this all important? Because we need a forecast. We need to be able to get our best guess on what's going to happen in the market so we can build the right investment strategy. That's why it's important. Because knowing all this stuff helps us put the pieces of the puzzle together to solve the equation, right? That's all it is. And forecasting, is it 100% right? No. All right, so it's another little thing I came up with years ago. There's some rules that we want to follow when we invest our money. Okay? So okay? Anything that you do for it, if you think of putting, excuse me, this actually goes up here. This is kind of a litmus test. Duplicatable, I don't even know if that's a word, but we're going to use it.
Duplicative.
There, whatever. Duplicative?
Yeah.
Okay. I'm not going to spell that. Okay, so duplicative. It means you can do it again and again and again, right? Okay? The biggest thing, if you think of all of your investments going into a box, okay, and everything's got to fit into this box, everything needs to be sustainable no matter what you do. So in order for it to be sustainable, it needs to pass two major rules. Number one, you need to be able to withstand a long-term market trend. So if you're thinking about a full economic cycle, that's typically anywhere between 12 to 15 years in a market. Are you going to have a recession? Yeah, you're going to go through a down recession, okay? You're going to have some upswings. You need to make sure that's going to easily sustain itself for that full economic cycle. Secondly, it needs to be duplicable. Duplicative. Thank you. Okay, he's a journalist, news anchor. That's why he knows. So, duplicative. So, which means we need to be able to do it again. Anytime you get people that say, hey, look, this is a new investment. It's never been done before. We're on the ground floor. We're groundbreaking. It's da-da-da-da-da. Any red flags go up? Like a million, right? Like ding, 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 ding. I'm in your ward. Give me your money. Whatever it is. That kind of stuff. That's a big problem, right? So you've got to be very careful with those types of things. It should be something that you can repeat. Real estate's been around for how long? I promise you they were flipping homes in the 1800s. I promise you. There was some dude saying, you know what? If I add 4 more bedrooms, then this family can fit their thing and I'm going to gain, $400. Whatever, okay? It was happening. They were building apartments. They were renting it out. They were doing all these things in the 1600s. And so it's really important to understand that concept. So when you think of if it's a new thing, no. Stay away from that, okay? All right. So let's go. Let's talk about strategy then. And then we'll be wrapping up. In order to build our strategy, we need to look at our market expectations. This is what I think is going to be going on in the market. Okay? So these are Aaron's predictions. Interest rates are going to go up, for sure. We've already seen them go up quite a bit in the last little bit. Okay? They are going to rise. I think they're going to go up about 2% over the next 3 years. Does that scare anybody? Okay. Cody, how old are you, my man?
25.
25. So you've been an adult for 7 years. What's the highest interest rate you've seen in your lifetime?
I don't know.
Probably right now. So 4.2, 4.3 or whatever. Okay. So that's an important thing to think about. One of the major demographics are millennials, and their ages between 25 and 35 or whatever, okay? That's the major demographic that is the major buying force coming through the market now. Most of those people in their lifetime have not seen interest rates above 7% in their adult lifetime. So with that, oh my gosh, 6%? Are you crazy? I bought my first place, 8.75%, and I was thrilled. The average interest rate, if you look at time, is 7.5%, right? So being at like 5.5% or 6% is not unhealthy at all, and it won't crush the market, I promise you. It's not going to spin real estate into this Great Depression. It will not do that. Also, one thing what's going to offset this? So if real estate prices go up or interest rate goes up, what happens to the affordability of real estate? It goes down. It becomes less affordable, right? Okay. What offsets that? Price reduction can offset it. What else? Demand will do. Yeah, demand helps, but what offsets the price, the affordability issue? Wages, right? You see now why it's important that we know that, wages are going to go up. You know what? I freaking hate Trump, but wages are going up. I love Trump, wages are going up. That's all we care about is wages are going up. Don't care about how you lean politically. You just need to know wages are going up. Okay? That's important. Okay? So, all right. So what is going to happen with this? Do you think it'll put a depression or stop real estate prices? No, okay, let's just do it by raise of hands. There's no right answer to this, by the way, because I honestly don't know. And I know I'm the guy teaching you, so that's probably a problem. But anyway, who thinks that interest rates going up will lower prices on real estate? Raise your hand.
Stabilize prices.
So, okay, stabilize or lower.
Yeah.
Okay. Who thinks because of other factors in the market, even with that going up, real estate prices are still going to go up? I think that. And I'm going to go through a few things and reasons why. Okay? Housing demand continues to grow and will continue to grow. Okay? So that creates that demand pull inflation environment, right? Our demand is still going up. We still are not producing enough for the current demand. That is what's happening right now still.
Some of the inventory too is just awful. I mean,
Terrible.
Some of the houses we've looked at downtown, I wouldn't put my worst dog in it. I mean,
Yeah.
they're just horrible.
Yeah.
And I think there are some people, they start getting paid more money, they're like, I'm not living there.
Yeah.
No way.
So let me tell you about a rental. So we do a lot of property management in our firm as well. And we just got a new countertop contractor. And him and his wife are renting over at a place called Sandpiper, which is close to where I live. And they're looking for another place. They want a 2-bedroom, kind of a townhome style unit. He's asking me about it. I told him about one that we just got done, remodeled, in an area that he really didn't want. He called his wife, rushed over there right away to look at it. He didn't rent it because he wanted it to be a separate kind of own unit. He told me his max budget was $1,300. He called me back and said, that would have been perfect if it wasn't for the other unit. I would have taken it in a minute. I'm renting it for $1,250, and I think in the summertime I would get maybe $1,350 to $1,400, right, Kelly? So anyway, that particular, and he said, is there anything else? You know what? We'll go up to $1,500. Boom, boom, boom. That's rent, guys. So here's some rental demand figures for you. Does anybody know what a healthy vacancy rate is?
3%.
3% is actually super low. 5 to 7 is what actually every single major multifamily player, we're talking about multifamily, we're not talking about office or retail, okay? Or industrial, but every multifamily player aims to hit on their stuff. So if you have a vacancy rate lower than 5%, you need to raise rents. So numerically, mathematically, it's proven if you maintain that vacancy rate in the market, you will make more money than having it full all the time. It's counterintuitive, right? But it's true. I can prove it to you multiple on math. But anyway, so they are predicting, they say, hey, what about all the apartments they're building and da-da-da-da? So, well, by 2022, it's predicted that we'll have a vacancy rate in Salt Lake City at 6%. Anyone know what it is right now? 2.6. Yeah, that's like 20. No, just kidding. So, anyway. So, 4 years from now, they're expecting us to be in equilibrium, basically. What does that mean for us right now? Opportunity, right? There is opportunity out there still. All right, so let's go through our demand's going to continue to grow. That's going to offset some of this. Our cost of inputs will rise. Labor and material costs are going to continue to rise, okay? That creates a cost push inflation. Real wages are going to increase. And here's the big one. Fundamentally, we're super strong. Do we have ninja loans? No income, no asset loans? No. People have to give down payments, okay? They have to qualify. We actually check all their stuff, all that kind of thing, okay? In the financial crisis, the average home price that was being built at that time was like $500,000, which was crazy. It wasn't the average price that that what people could afford, the average home price was right around the high 200s. But anyway, now we're sticking with levels that make more sense. They're building in the low 3s to 400 range. That's your bulk of your new construction. Okay? So condos and townhomes had their biggest percentage of sales ever here, and that the average price is right around 200,000, a little over 200,000 for that. Okay? So fundamentally though, also, where's our money? How strong is the money supply and everything? So let's talk about money supply, because if money supply dries up, all the fundamentals are going to be great, and what's going to happen to the housing? It's going to collapse, right? It's going to go down, it's going to stop, it's going to come to a screeching halt. Okay? How much money came back into the market? $2 trillion. So even if the Feds start ratcheting things up like crazy, which they won't, they just want to make sure we have regular inflation. Even if they do that, we still have tons of money coming in. What was the other thing that Trump did on infrastructure? How much money is he going to spend on infrastructure in the U.S.? It's going to be added to our deficit, which I'm not a big fan of, but it's a big deal, right?
Paying the deficit with inflated dollars, so it's not so bad.
That's the other thing. So what is the best thing about inflation when you own a leveraged asset?
It's cheaper.
Compounded appreciation.
Okay? Yes, that. And it's cheaper to pay it off. Every time there's more inflation, it's cheaper for you to pay that debt. Right? That's a whole other story for another day, but that's a very good thing to think about as well. All right. So strategy components. So things that we need to think about. Do we want to focus on growth? Do we want to focus on cash flow? Or do we want to do both? Of course, we're going to do both. So let's talk about a plan. So let's build this out. Whenever you build any financial plan, I don't care if it's real estate, I don't care if it's in the stock market, anything like that. So this takes us about 5-10 minutes, then we're done. There's the one thing we need to ask ourselves, okay? What can we control? What can we control in the market? When we go buy real estate, what do we control? Exactly. The price we pay or what we buy, okay? We control the buying, period. There's an old saying in real estate, you make money when you buy, not when you sell, right? So it's probably the same with stocks and everything else. It's all about how you buy. So Apple, how many people like the company Apple? I like them, right? Okay, I got an employee that makes fun of me for having an iPhone all the time. But anyway, it's a great company, that kind of stuff. Okay, in this recent 2-week dip that we had in the market, so it's recovered a bit since, but when Apple went down, or what did it go down? Glenn, you probably know. Was it 10%? Does anyone know how much Apple went down? 8%. If you know Apple's a strong company and it went down 8% because people are being crazy in the market, what should you do? Buy Apple stock, right? Because what's going to happen? If it takes a day, if it takes 2 weeks, if it takes a year, it's going back up, right? Why, though? Really important. Fundamentally super strong, great brand, innovation, all the kind of different things. All the things are pointing to, hey, this company's going to grow. Oh, and also, by the way, it's bringing in hundreds of billions of dollars back to the U.S. to build factories and all kinds of different things, right? I mean, lots of good things going on for Apple right now. So, okay, again, we control how we buy. Okay? What else do we control? Timing, yeah. Information. Okay, knowledge is power. I've been in real estate for, like I said, 20 years. I went back and got my master's degree in real estate development. I just graduated last year. Okay, I'm not going to get a job. I own my own company. I don't need the degree. It doesn't do anything for me from a financial standpoint. Why did I go back? Okay, So there's something, you guys, it's knowledge. It's all about it. So there's something that we in the U.S., what makes us so much better off than so many other countries and places like Great Britain and other countries, Canada, those types of things. It's called human capital. Okay? Human capital is increasing your knowledge, your productivity, all that stuff. Do you know that we produce 8 times more what other third world countries produce? So if you have a third world country producing an iPhone, we can produce, one of American worker can produce 8 times that one person can, right? And we're not going to use that example because costs and everything else, there's a reason why they're in China. But anyway, what I'm saying is that's why we continue to be, with the exception of Australia, I don't know what it is out there. I'm just kidding, Nathan. So, but they're the same, right? Australia is also a first world country. Education is really important. Teaching their kids and having them grow and learn more and gain more skills and more knowledge, right? So I went back because I knew I need to be humble enough. I need to learn more. What more can I learn? It was a very good move for me. And everything I learned from that, I increased my human capital and what I could do, right? So we control information. So I learned more about that. So, for instance, I'm working on a deal right now. It's a little fiveplex out in Lehigh, okay? So the units there, 4 townhome units, then like this house that they split up that's connected together, and they're using it like a sixplex. So what did I do? I called the city. Well, I had Cody call the city to find out if we can get that rezoned to a sixplex. There's a possibility that may be a possibility for us to do fairly easily. So if I can rezone it to a sixplex, I have legal rents from that 6th unit, which increases the value, okay? Secondly, those townhome units, they're 2-bedroom, 2-bath units right now. 2-bedroom, 2-bath units in this particular area go for between $1,200 to $1,500 a month for that unit. He's renting them out for $875, right? So that particular unit, I can just do that and increase it, right? However, 3-bedroom units go for a minimum of $1,350 all the way up to about $1,900. So if I spend $15,000 a unit, I can gut the entire upstairs and create 3 bedrooms, 2 baths up there and start at $1,350. So knowing about knowledge, rental units are all based, the value is all based upon the income it produces, okay? But if I go from $875 to $1,350 on one unit, what's the difference? It's we'll call it $500. It's $475. No, that's not right. What is it? It's someone do that for me, man. $475? Okay. See, I was right. Come on. Anyway, $475 per unit. Okay? Who's got a calculator on them? Are my expenses going to increase? No. Because I'm going to spend the same amount of money whether I have a 3-bedroom unit or whether I have a 2-bedroom unit. Because if a tenant destroys it, they're going to pay for it.
So you're taking your remodeling cost down.
So yeah, remodeling costs, we're putting it in there. But I'm talking about, when I say expenses, I mean maintenance, monthly expenses, not capital improvements. Okay? That's a good thought. You got it, Parker?
Yep.
Take $475, multiply that by 12.
5,700.
Okay, divide that by 0.055.
0.055.
Yeah.
Okay, that's 103.
103,000?
Yes.
That's the increase in value per unit. If I get an extra $475 per unit. Okay? So that strategy, I control when I buy, I control the information on the rental market, how to remodel it, who I'm going to rent to. All of that I can verify and I can check out, right? I can do all that work. So I can control all of that. So all of this I can control and I can understand this information. What else do I control? Yeah, location. So location, yeah. That's all in the buying, so location is important. Why is this location important to me? What's that? Silicon slopes. What is going on over there? How many cranes do you see over there? I love driving down and seeing cranes. So my wife and I went to England, London for the first time. When was that, Kelly? When did we go to? 2 years ago, Cody? Okay, 2 years ago. And so I'm a nerd about real estate. I went to a conference in D.C., and this was, I don't know, 8, 9 years ago. I don't know how long it was. I went to a conference out there. And on my free time that I had, I rented a car, and I drove around neighborhoods and pulled flyers on houses and drove through the city and looked at real estate. So that's what I did for fun. And so my wife's like, hey, let's go see it. I'm like, great. I'm like, hey, what do you want to see? She said, I don't know. What do you want to see? And I look at the city, wherever the cranes were. I'm like, let's go over there. So we start walking. We get taxis, and we just start looking at the construction and the real estate, right? Because I like to see what's happening. And all that, I get jazzed about that kind of stuff. And so anyway, but those understanding what's going on in the market, Silicon Slopes, all the growth, what's going to happen? Just by what, like we just decided wages are going up, right? Promise you, Google it, you're going to see just as many arguments as why they're not going to increase as why they are. But if you're a smart investor and you have any common sense, you know it's going to go up, period, right? So just by doing all of that, what do you see, Josh?
Just the Silicon Slope. I work over there, and to get people there, they had to increase what I do for a living, our prices up, just to get people to come in and finish their project.
And it was a significant increase, right? So where Josh is, Josh works, he's a pipe fitter foreman for the union. And they are paying them, at one point they were doing 13 days on, 1 day off. And overtime started after 8 hours a day, right? And then Sunday it's double time. And it's not cheap labor, right? So do you realize how much they're paying? Do you know why they do that? Do you know how much they're losing by not having that facility done? It's massive amounts of money, right? But then they need people to staff all that stuff too, okay? So I know what's going to happen to the population of that area. People need to move there, and rents, they're going to continue to go, and they cannot build them fast enough. It will not happen. So what's going to happen to rents to that building? Crappy little fiveplex, just going to keep going up and up and up and up and up. It's not crappy, I shouldn't say that. But it's just going to keep going up. So if the average appreciation rate in Utah over time is 3.5%, but I'm in an area where tons of money and infrastructure and everything else is pouring into that area, what do you think the average appreciation rate for that area is going to be? 5, 6, 7, maybe more, right? We see that all the time. So Sugar House has historically performed better than any other market in Salt Lake City from appreciation standpoints. Okay? What were the areas that got hit the worst in the economic crisis, in the financial crisis? St. George got hit. What else? Eagle Mountain. Park City. Areas where they have lots of land and they're far away from things and not a lot of infrastructure, right? What areas, how much did Sugar House go down? Yeah, they went down. Like 10%, maybe 15 at the most. Eagle Mountain was hitting 60%. Okay? All right, so anyway, so we control the buying, we control the information, as much information as we can, right? Okay, and then we also, to some extent, can control the financing, or what we choose, anyway. Right now, so if we're in an environment, if we want to create safety for our strategy, okay, what kind of loan do we want? Conventional loan, okay.
Or a private, like a family member loan or
Okay, either any of those are fine. Whoever the lender is, I'm not really as concerned. I'm worried about the type of loan. Like, do you want to take interest rate risk on as an investor right now? Why?
It's going up.
You know interest rates are going up, so what do you want to do? You want to lock that rate in as long as you possibly can. So in residential, we can get 30-year fixed mortgages, right? So we can have a fixed rate for 30 years. We are historically still in historically low territory. What do you think rates are going to be in 20 years? Probably higher. 15, probably higher. If they go back to average, they're going to be at least 6.5%, 7.5%, right? Now, it's possible that they stay where they're at. We've seen cases like that. Japan is still kind of a crazy case, right? So anyway, so that's possible, but fundamentally, our fundamentals are different. I don't think that's going to be the case. So fixing that rate in is really good. In fact, Warren Buffett, right after the crisis in 2009, 2010, did an interview. And he said, "God, if I were an individual investor right now, I would buy a bunch of homes, put them on a 30-year fixed loan. It's a great way to own a leveraged asset." When everyone else was dumping them like crazy. What did big hedge funds do? They bought them. They own enough in certain markets to move the market in real estate, which is scary. That's crazy, right? All right. So, but we can control what we do. So as an individual investor, remember my story about the economic lesson, right? From my professor? How do we protect ourselves? So the one thing we have to do is we have to protect ourselves from risk. So if we're going to get a commercial loan, we want to make sure we get a fixed rate for as long as possible. A lot of commercial paper wants to be 5 years, but they will do 10. So we always want to push out to 10. And they'll do 30-year amortizations. Why are 30-year amortizations important? Lowers payment, cash flow. Would we rather have the money going into our bank account or into the mortgage? It's an important question. Why? Why do I have an Echoline on my house? Damn it, I want to control my assets. I want to be able to use my money when I choose to, when I want to put it to work where I want it to go. And if I don't have access to it, I can't do anything, right? That was the biggest problem in that financial crisis. So control. So if we have greater cash flow, we can put that money in the bank. If we choose to throw it towards the mortgage to pay it off earlier, great. Now I'm fine with 15-year mortgages. I've got a 20-year on my house, right? I'm fine with all of that. Again, choices you make, but understand what you're doing. So as we're building the strategy, we need to understand, number one, we control what we buy, when we buy, how we buy. Are there still good deals out in the market? Yes. I'm finding them every day. This particular deal was one I sold to a client of mine. I gave them all this information. Right, Cody? Every bit. I told them exactly what the building was going to be worth. This is how much money you'll make. I told them exactly how to do it, how to refinance it. Nolan knows, Kelly knows, Cody knows. Cody was intimately involved in it. They chose not to do it. So I said, great, I am going to take it. And they said, okay. Okay? So, Sergio, the only one smart enough when there was a lot of supply to give me $5 for $20, right? I know it's kind of a trick game. I'm not saying you're not smart or anything like that. What I'm saying, though, is if you knew the information, if you had the information that, hey, he's going to give me this $20 for whatever I give him, you're going to try and get the lowest amount possible, right? Okay? Information is power, guys. You got to know. We control when we buy, how we buy, where we buy. We control that information, and then we control our exit strategy and our safety precautions. All of that stuff we can control. So, when things went awry in the financial crisis, whose fault was it? When people lost money, when I lost money. You know how many? It was mine. Do you know how many people said, "Oh, Aaron, it was the market, man, crazy." And I'm saying, you know what? You're right. That was fuel to the fire. Yes. But ultimately, some poor choices I made, I screwed up my sustainability, right? some poor choices I made caused me to lose a lot of money and have to take drastic measures. So it's really important, as investors, we're mature enough to know, okay, that we control that. So we can control what we do, how we buy, when we buy, all that kind of stuff, and I can help you. So for those of you who want help to finding programs or a plan, anything like that, many of you in this room are my clients and investors and partners on different projects, okay? I always do customized plans for everybody. Anybody who wants it, even if you don't use me, anything like that, it's a free service. And the pitch to buy a program for $20,000 is coming up next. No, just kidding. I don't do that either. We don't sell education, it's all free, okay? So how do we make our money? We hope that the value that we have, that you would use us to invest and buy real estate, and we'll help you do that. That's an important part of our business, okay? But if you don't, I have done multiple plans for people and helped them, and they've executed those plans on their own, and that's fine. You know, I'm a big believer in call it karma, call it goodwill, call it whatever you want. What goes around comes around kind of a thing, okay? I can help make a plan for you, whatever you want to do that way. Come talk to me after. Thank you for your time. Any questions before we end real quick?
Just a question. When the market took a dive last week, what's the reason? Why do you think that happened?
There are a couple different reasons. The main reason why, fundamentally, we're really screwed up, okay? So our supply, we had way more supply than demand. So we had so much inventory out there, like a $500,000 home, you couldn't rent it for $2,000 a month, $2,200 a month. They had hard times, so a lot of vacancies there. So that was an issue. All of that toxic debt. What happens? So these investors, they go and they buy this debt, right? So think of it like your 401k plan or your pension at work, whatever it is. They're basically just conglomerates. They buy billions of dollars of this debt, of these mortgages, okay? And the mortgages, they came back and they said, hey, they're A-rated. In other words, this particular mortgage is going to pay. The default rate on an A-paper mortgage is super low, right? Well, you know, they underwrote them wrong, all that kind of stuff, and it was toxic debt. So because of that, they had huge defaults in that mortgage. So if you had a value, think of it like this. If you give me $100 and you're expecting $110 back, okay, and then I give you $70 back or $50 back, right? You lost half of your portfolio value, 30% of your portfolio value, whatever. Boom, just like that. What happens to you? You're a bank, you're a financial institution. That really screws you up. You can't lend money out. You don't have it. You don't have money to lend out. So,
You talked about the market just a couple of weeks ago, just the stock market.
oh, okay. What caused that? I think it was just a sell-off, personally. A lot of it, a lot of it talked about technology. Ryan would know more about that. What I would do is I would talk to him after. My personal opinion on what I think happened with it, I think part of the technology is because our technology is so good now, if it even kisses a stop on any position that you have, it's going to sell out. But I also think people are just taking profits. I mean, we're super high. That's what I think it is. I don't think it's any reason to panic. Here's the other thing I do. I do another training where we talk about how to think about investing. And I talk about terms of money. I do another money thing. So anytime I ask for volunteers, you should come up. Okay, so anyway, but I do another money thing. And I try to teach people in terms of, think in terms of percentages. So everyone said, you hear the news, right? I hate the news. But you hear the news, they said, biggest drop ever. What was the percentage loss? How much was it?
At most, it went right to 10% and then bounced back. So we lost 10% in the market.
Mm-hmm.
Within a couple of days, we're back up at -5. And
5%, how fast will we get 5% back? Oh, a month. Something like that, 2 months. I don't know. But anyway, there's probably a way more technical answer that Ryan can help you with. But anyway, sorry, I thought you were talking about the other one. Okay, anyway, guys, for those of you have any questions afterwards, come talk to me. Make an appointment with me. Let's talk. Be happy to go through everything. You can also schedule it with Cody as well, and we can get together. Thanks for coming.